In this week's video, we'll review the latest charts and data to help us answer the question, did the Fed just signal a recession and bear market? We'll be moving quickly, so feel free to use the pause button on your video player. The Fed cut interest rates this week by 50 basis points, and ultimately the question is, will the economy avoid a recession? If so, this is the type of performance that we've seen. The outcomes in the stock market following the first cut in 1984, 1995, and 1998 were very satisfying. But that doesn't mean a whole lot unless the U.S. economy avoids a recession. So let's take a look at current trends, the charts in front of us, asset class behavior, and economic data to try to discern how relevant the returns on your screen are to the present day. Top portion of the screen is S&P 500 returns walking forward after the first rate cut. Bottom portion, NASDAQ composite returns. If market participants believe the U.S. economy was about to enter a devastating recession and we were about to see a big hit to corporate earnings, we would expect the right side of this chart to look more like this rollover look here, where we're transitioning from risk on to risk off in late 2021, early 2022. But that's not what we have in the present day. We have a full-bore bullish look for the most part, with blue the fastest moving average on top, the 50-day moving average, and silver the slowest moving average on the bottom, the 250-day moving average. And it's noteworthy that Dow Jones Composite Average is highly diversified and not tech-heavy. 37% in industrials, 13% in utilities, 12% approximately in financials, 11% in healthcare. The longer a market goes sideways, the bigger the move that you can expect to get when you either get a bullish breakout or bearish breakdown. Right now, we have a bullish breakout. And if present-day market participants were concerned about a recession as they were in the year 2000, we would expect momentum on the monthly chart of the Dow Jones Composite Average to be waning as it was here and here. Similar situation in the financial crisis bear market. Late in 2007, momentum starts to wane. We get a bearish cross here on PPO, which is very, very similar to MACD. If you know your stock market history, you know the S&P 500 peaks in May of 2015 and doesn't find a bottom until February of 2016. And you can see in 2015, before the S&P 500 peaks, we can see it, measure it, put it in a model. CCI drops below this 100 level here, indicating weakening momentum. We get a bearish cross with black below red here on PPO early in 2015. Similar waning look here in 2020, and similar waning look late in 2021 into early 2022 during the bear market. As you can see, the present day really doesn't look anything like those periods. Momentum looks much better during the trading session on Friday, September 20th. Instead of getting a bearish cross, bearish cross, bearish, 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 we recently experienced a bullish cross with black above red occurring above the center line, telling us that this looks like a counter trend move in 2022 within the context of an existing uptrend. And the fact that we have the bull cross and we're holding that bull cross says we have resumed that uptrend. Very similar situation here. Once again, looking at the Dow Jones Composite Average, the highly diversified Dow Jones Composite Average. This is a weekly cloud chart. In 2022, eventually, we can check all of the bearish boxes. Bad things start to happen late in 2021, early in 2022. Conversely, in the present day, on September 20th, 2024, we are clearly checking all of the bullish boxes on the weekly cloud. So does this chart here, and this favorable look here tell us that we have new leadership? It's the new leadership in industrials, utilities, financials, and healthcare. And is the leadership run in information technology, OVER? Well, if that were the case, we would expect to see a similar bullish turn on the chart of the Dow Jones Composite Average relative to the NASDAQ. Is that what we have? That is not what we have. We still, on September 20th, 2024, clearly see the Dow Jones Composite Average relative to the NASDAQ 100 is in a downtrend. The last thing it did was make a new low. It has not made a significant higher high. This high here did not exceed even this high here. Right now, this looks like a counter trend move within the context of an existing downtrend, with all of this movement since July of this year occurring below a downward sloping 200-week moving average, indicative of a long-term existing and still in force downtrend against the Dow Jones Composite Average and favoring the NASDAQ 100. What does it say about the NASDAQ 100 and the stock market in general? If one of our laggards has a favorable look, like the top portion of your screen, a favorable look in isolation on the monthly chart, and a favorable look in isolation on the daily chart. By default, it tells us the chart of the NASDAQ 100 in isolation can't look that bad. This is what we should have done when we reviewed the first set of charts, the charts of the Dow Jones Composite. Forget about the Fed rate cut. Trade the chart in front of you. The facts are sometimes the Fed cuts rates and really bad things happen after the first cut. And sometimes the Fed cuts rates, the case is shown on your screen, and really good things happen after the first cut. Thus, we're better off forgetting about the cut for now. So for the remainder of the video, just review the charts. Pretend you don't know anything about Fed policy. Forget that the Fed just cut rates by 50 basis points, and review the charts in an unbiased manner. Now we're looking at the more widely followed Dow Jones Industrial Average. This is early 2022 here. This is the transition from the bull market to the bear market. Eventually in 2022, we're checking all of the bearish boxes on the weekly cloud. On September 20th, 2024, we are checking all of the bullish boxes, and it's not even close. This really doesn't look anything like this rollover look in 2021, early 2022. This is a favorable weekly cloud look after a favorable bullish breakout. Then we consolidated above this level here, and now we're pushing to new highs. And once again, what does it say about your market leaders when a laggard, the Dow, which is still clearly lagging on a trend basis relative to the NASDAQ Composite, looks this good? We don't want to get too cute when our laggards look this favorable. The Dow relative to the broad NASDAQ Composite went up to a downward sloping 200-day moving average in red in this case, and thus far has failed and is back below that downward sloping 200-day moving average. The last thing this ratio did was make a significant and meaningful lower low. It has not exceeded this high here from earlier in 2024. If the ratio can get out here and the 200-day moving average can turn back up, then that would tell us something about the possibility of a leadership shift. Right now, this still just looks like a counter trend move within the context of an existing downtrend. Having said that, the Dow in isolation looks good. And there's no question that your market leaders have been relatively weak here since the NASDAQ peaked in July. You can see the market made a stand here at an important region in terms of volume by price, and also relative to this trend here that dates back to early 2023, late 2022. And if we zoom in on the right side of the screen, as of the close yesterday, on Thursday, September 19th, we completed step 3 of a probabilistic trend change for this intermediate term counter trend move. We recently broke above this trend line here. After that, this is a higher low here, step 2, relative to this low. And yesterday, on a closing basis, we made a higher high above this high, telling us the odds of the prior uptrend resuming are higher today than they were just a few short weeks ago, and it serves step 3 as a follow-through to step 2 here, which was waning fear on this second decline in early September relative to the level of fear in early August. You would draw the same conclusion if you looked at the moves in the VIX, the spike in the VIX on August 5th relative to the recent highs in the VIX. You can also see the resumption of the trend look here when we zoom in on shorter term time frames. This is the 8-day moving average in blue out to the 50-day moving average in gold. It's easy to make the argument that this period in here looks similar to this window in here. We're exceeding this high here, or this look in here where we exceed this high here. On a closing basis, again, we exceeded this high from early August. All of the recent consolidation in here has been occurring above this upward sloping trend line from this October low in 2023. And if we move out even further on the weekly chart with the 30, 40, and 50-week moving averages, we have a full-bore bullish look. And this counter trend move here looks very similar to the look of price relative to the moving averages during this counter trend move that occurred in 2023, and eventually the Nasdaq went on to print a higher high. The fact that we have white space between these moving averages and prices above the moving averages, that's a strong trend look. This really doesn't look anything like this rollover period here in late 2021, early 2022. It's also noteworthy that as of the close on September 19th, cumulative Nasdaq new highs minus new lows exceeded this level and this level. And unquestionably, the look of this data set has improved significantly relative to late 2023 and early 2024. Very similar look here, same data set, Nasdaq new highs minus new lows. This looks a lot more like this favorable period after the major low in 2009. This looks a lot more like this favorable period after the major low in October of 2002, relative to this unfavorable look here in Q1 of 2008. We've shown this chart many times. The message has been the same over and over again. The monthly cloud of the NASDAQ 100 has a favorable and bullish look. We're checking all of the bullish boxes. It doesn't look anything like this rollover period here, nor this rollover period here. And it looks a lot like this period in here after the major low in 2002. And the present day looks a lot like this period in here after the major low that occurred in the S&P 500 on March 9th of 2009. This is a monthly chart of the NASDAQ 100 index, checking all of the bullish boxes. When we try to look at historical data and try to interpret what the Fed's 50 basis point cut means, ultimately that's a form of forecasting. That's crystal ball stuff. That's in stark contrast to trading the chart in front of you. This is a key point. Focusing on and understanding what is happening is infinitely more important in the world of investing than trying to figure out what may or may not happen in the future. These are facts on the chart in front of us. The future is full of unknowns. And once again, forget about the Fed rate cut. Forget about all the talk about a recession and focus on the chart. This is the concerning rollover look here in early 2022. Notice how weekly Williams percent arm momentum in January of 2022 falls off the table. We don't have anything like that over here in recent months. In fact, momentum during recent consolidation is stronger than any of these moves back here. Look at all the white space between Williams percent R and the bottom of this range. All the white space and the bottom of the range. Not the case in January of 2022, and not the case numerous times during the bear market in 2022, and even during this counter trend move in the early stages of the current bull run. This looks a lot better than this, and this on the right side of your screen looks a lot better than 2022 during the bear market. The same can be said for price. We dropped below the 40-week moving average in January of 2022, and then we come back up, try to recapture it, and we fail. Looks even worse here in August. We can't even get a weekly close above it. And this is almost the polar opposite. Then we come back and we test it here, and we overshoot it, similar to this look here, but in the other direction. And then in the recent past, we look even stronger. We did not get a weekly close below. In fact, we didn't even touch the 40-week moving average. So this pullback here tells us that market participants were not as concerned as they were here. Same can be said for momentum. Downside momentum is stronger on August 5th than it is on the recent pullback in early September. And all of this consolidation since June and July of this year is occurring above an upward sloping 40-week moving average, which is in stark contrast to what was going on in early 2022. And if you don't like indicators and you don't like momentum and you prefer price, well, price in early 2024 broke above this level here from early 2022. This was our first weekly close here in January of 2024 above the blue box. The longer a market goes sideways, the bigger the move you can expect to get when you either get a bullish breakout or bearish breakdown. And in this case, we have a bullish breakout. This looks like a retest look. Price holds above the prior blue box here. And then when we come down here, we get a higher low relative to these lows earlier in 2024. And now we have gone on to print a higher high above these levels. If market participants believed a recession was right around the corner, we would expect the present day chart to look more like this, and really not look anything like this, nor this. A lot of the things that we just talked about, you can see them more clearly if we zoom in on that same chart. Recent low on the weekly chart, higher than this low here in July. All of this consolidation in the S&P 500 occurring well above an upward sloping 40-week moving average, and momentum has looked strong. We're nowhere near these oversold levels down here like we were in calendar year 2022. And again, when we look at this chart, we don't have to try to forecast what's going to happen. Let's focus on what is happening. And if the present day chart morphs into something like this, where the monthly PPO clearly has a weak look with black below red in late 1999, early in the year 2000, then we would be concerned. Similar look here in late 2007, early 2008. Similar look here in early 2015. Similar look here with a bearish cross black below red in early 2022. We have the polar opposite in the present day. We have black above red. It looks like momentum on the monthly chart is improving. All of this is occurring above the center line, once again telling us mathematically this is a counter trend move within the context of an existing uptrend, and we have now resumed the uptrend. Compare and contrast the look of the candlesticks or price relative to the 40-month moving average in blue and the 85-month moving average in red in here. This is a strong trend look. Contrast that with the look during the period of secular stagnation in here, where the moving averages and price are all over the place within the context of this orange box. Eventually, in 2013, when the secular bull begins, we clear finally these highs from 1999-2000 and these highs from 2007-2008. The look of the moving averages and price shifts significantly and discernibly relative to the orange box, as does momentum. During the period of secular stagnation, you do not hold the zero line. You do not hold the zero line. These are clear downtrends. And this, in 2015, looks like a counter trend move, and this looks like a counter trend move within the context of an existing secular bull market, aligning with all of the themes that we've covered in these videos for several years. This S&P 500 advanced decline volume weekly. S&P 500 performs well here in 2013. You can see we break above this black box. S&P 500 performs and moves strongly, and it's trending in 2017. We break above this box. Contrast that with the look in 2022, where we're moving in January in the opposite direction, and once again we're back above one of these black boxes. This here in 2024, similar to this look here and this look here, and really doesn't look anything like this look here. Dow Jones Corporate Bond Index. Read riskier and higher yielding corporate bonds relative to U.S. government bonds that are backed by the full faith and credit of the U.S. government. You can see corporate bonds regain their footing here as the S&P 500 is bottoming in October of 2002, and you can see good things happen in the stock market after that. Similar situation here. We have a brief undercut of an upward sloping 200-week moving average in red. Then corporate bonds find their footing. Just as we're returning to risk on in the S&P 500, the market rallies here from 2009 into early 2018. I believe this peak was on January 26th of 2018. September 19th, 2024, a very favorable look, and it looks like the 200-week moving average is starting to flatten back out. It would be nice if it turned back up. This chart was helpful during the crash on August 5th, and I believe we showed it on Twitter. And I say that because this image from August 2nd, the prior Friday to August 5th, is a small image, and it looks like it was made for Twitter. During the sell-off on August 5th, the prior Friday, corporate bonds were telling us, don't overreact here. This is a very favorable look on that same chart. This was Friday, August 2nd, and on Monday the market crashed. And that turned out to be useful information, because today the S&P 500 is significantly higher relative to the closing level on Monday, August 5th. I've covered this in the past. The same corporate bond index, now this is a daily chart with the 200-day moving average. Compare and contrast the look of corporate bonds relative to the 200-day moving average in 2023, where they're still indecisive, and in 2022, when they're clearly in a downtrend. Since early 2024, all of this indecisiveness is occurring above an upward sloping 200-day. This on the right side looks better than this in the middle, and this in the middle looks better than this on the left in 2022. And the right side looks the best of the three periods, which speaks to a return to confidence and risk on. This looks similar to this look here when? In 2009, as the S&P 500 was bottoming and we were returning to risk on. There's nothing definitive about any of this. It's one small piece of the weight of the evidence, but all things being equal, it's an improving look relative to the market's acceptance of risk, relative to its aversion to risk. And that's what this is all about. Midcaps during the trading session on September 20th, 2024. The longer a market goes sideways, the bigger the move you can expect to get when you either get a bullish breakout or bearish breakdown. In this case, we have a bullish breakout with a full-bore bullish look with price above all of the moving averages. The slopes of all of the moving averages up. Blue, the fastest moving averages on top. Green, the slowest moving average. The 50-week moving average is on the bottom. This looks like a bullish breakout that occurred earlier in 2024. An indecisive consolidation look, but above this level here from late 2021. There's nothing on this chart here that looks bearish. And this too is a laggard, because this is what the same chart looks like relative to the NASDAQ composite. It is still in a downtrend, and it still has a full-bore bearish look against midcaps relative to the NASDAQ. And the same can be said for midcaps relative to their large cap brothers, the S&P 500. Price is below all of the moving averages. The slopes of all the moving averages are down. Blue, the fastest moving average, is on the bottom. That's the polar opposite to what midcaps look like in isolation. What does that tell us? It tells us midcaps look good. The S&P 500 looks good. The NASDAQ looks good. And midcaps, from a weekly trend perspective, are still laggards. But overall, we have a very healthy market. You can pause your video player here. This is cumulative NYSE advance decline. Financial crisis concerning look. 2015 concerning look. 2022 concerning look. Contrast that with the improving look in 2010, 2013, and 2016. There's no question this looks like 2010, 2013, 2016 relative to this look here and this look here. which speaks to the probability of good things happening relative to the probability of bad things happening. That's a nice look. S&P Composite 1500. Full bore bullish look on the weekly with the 30, 40, and 50-week moving averages, trying to print a new weekly closing high on Friday, September 20th. How does this look relative to the S&P 500? The broad 1500 index is still clearly in a downtrend here, and the same can be said for that broad 1500 relative to the NASDAQ 100. And why is that relevant? Because the S&P Composite 1500 index combines the S&P 500, the mid-cap 400, and small-cap 600. So if mid-caps and small-caps were starting to turn relative to the S&P 500, we would expect to see more improvement on this chart and this chart. And that may happen very, very soon. It just hasn't happened yet in any meaningful way. But the fact that the chart of a lagging relative to the S&P 500 and the NASDAQ 100 looks this good tells us something about recession odds and tells us something about keeping an open mind about much better than expected outcomes after the first Fed cut. Since the million-dollar question relative to the first cut is recession or no recession, let's go to B and C here. Let's look at economic data directly, and let's look at asset class behavior to see what we can learn about bull-bear probabilities. Back to the million-dollar question. We've covered this numerous times. You can pause your video player, but common sense tells you that when people are afraid of losing their jobs or are starting to lose their jobs, that tends to be the first domino to fall on the way to a recession. And back in December of 2023, we used these charts to make the case that it did not look like we were getting ready to enter a recession, and that turned out to be helpful. Clients and regular viewers know that in recent decades, the National Bureau of Economic Research has tended to focus on two measures to determine whether or not the U.S. economy is in a recession: real personal income, less transfers, and non-farm payroll employment. And we've covered this many times. Real personal income, excluding current transfer receipts, clearly rolled over into a downtrend during the 1973-74 bear market and during the recession in 1973 into 1975. And remember, trade the chart in front of you. You can make the argument, well, Chris, see, this data rolls over at the same time that the recession starts. In many cases, that's true. So during this entire period here, the debate could have been, well, this doesn't tell you anything because the chart could roll over. But if you use the data properly, you would have said, this data set still looks good. I shouldn't be worried yet. And then when it starts to roll over, my concerns should increase. You trade the data set in front of you. So if you use that logic in the last 2 years, well, this data can roll over at any time, therefore it's not helpful, versus looking at it every single day over the last 2 years and saying, it looks fine, it looks fine, it looks fine. That's been very helpful. Trade the data set in front of you. And when that data set starts to roll over, then we'll start to learn something about bearish probabilities. Weakening before the recession, weakening in this window here, clear weakness 1990, 1991. Same data set starts to roll over here, recession here. Financial crisis starts to roll over hard. COVID drops like a stone. We use this same data in 2022. Since everyone's been talking about a recession for several years now that hasn't happened, to say it just doesn't look that bad. How does it look today? It just doesn't look that bad. It just made a new all-time high. And yes, it could roll over tomorrow, but you could have said that any time in the last 2 years. It could roll over tomorrow. 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 That's true, but let's wait to see it roll over. Something that may happen very, very soon, but it hasn't happened yet. Same exact concepts here. Trend down before the recession. Weakening, we have a recession. Same concepts here in the 50s, into 1960, into the 1970s. Same data set, total non-farm payrolls. weakness, weakness, shaded area, recession. Weakness, recession, 1990, 1991, dot-com bust, financial crisis, and a new all-time high relative to the last data set we have in hand in 2024. Again, any time in the past 2 years, you could have said it's about to roll over. And when it does roll over, because it will at some point in the future, we'll learn something about increasing bearish probabilities. It may happen very, very soon, but right now this data set unequivocally tells us that based on the data that we have in front of us, we do not even have the first domino falling yet. And that speaks to the odds of recession, just as this data set from Yardeni Research helps us with the same question. Here's the recession in the shaded area here during the dot-com bust. Here's the recession here during the financial crisis. And you can see the blue line, S&P 500 earnings per share, starts to roll over before the recession, rolls over before the recession. Similar with the red line. In this case, it rolls over before. In this case, for the most part, coincident, but you're still learning something in here as it rolls over. Is that what we have in the present day? We do not. Both of these lines recently made new highs. And in terms of forecasted earnings, and that's the key, and that's really where tech comes into play with their earnings. End of 2024, here. End of 2025, here. End of 2026, here. And yes, it's possible that these forecasts could be revised. And we'll learn something if they are revised, but they haven't been revised yet. And that also tells us something about bearish probabilities, very, very similar to the coincident economic indicators relative to S&P 500 forward earnings. Rolls over, rolls over, rolls over, shows some weakness, rolls over, rolls over. It's just not really what we have over here. The trend is still up. And if you look at all of the charts and the data sets that we've covered thus far, it simply tells us to be open to good things happening after the first Fed rate cut, similar to 1984, 1995, and 1998. How about asset class behavior? This is defensive staples relative to growth-oriented stocks, or the S&P 500. You can see as the S&P 500 is rolling over here in 2007, early 2008, this defensive ratio spikes higher. This is increasing fear. It crosses above the 200-week moving average in red here. Similar situation in 2015 when we get this double dip in the stock market. This is also increasing fear. Increasing fear here in 2022. You can see the ratio starts to move higher like a rocket. What happened this week during Fed week? This is intraday on September 20th. The same ratio. Is it rocketing higher? No, it's down 2.93% this week. And all of this is occurring below a downward sloping 200-week moving average. That looks a lot different relative to Q1 of 2008 in the early stages of the financial crisis. Same basic message here, and we look at the same ratio on a monthly chart. You can see it crosses above the 50-month moving average here in late 2007 or early 2008. And if you know your stock market history, really bad things happened in the stock market into March of 2009. It's not what we have in the present day. Concerns would increase if we had a rocket higher look like this. So far this month, it's down 0.98% or 1%. And the last thing it did was make a lower low. It hasn't made a meaningful higher high. So even if it takes on a look like this, concerns would increase. But even that hasn't happened yet. And all of this indecisiveness in here in 2024 is occurring below or downward sloping 50-month moving average in blue. Contrast that with the look here in calendar year 2008. And this chart was helpful in August. We covered it in the August 16th video. This is the S&P 500 relative to Treasury bonds. And we noted as the S&P 500 was peaking in the year 2000 before tech stocks took it on the chin, the Fed raised interest rates 3 times, totaling 100 basis points. The Fed just cut interest rates by 50 basis points. It was very difficult to compare the peaking process in the year 2000 as far as Fed policy goes to the present day. And in August, this ratio overshot an upward sloping 250-day moving average in black and held, as we noted on August 16th. How does the same ratio look today? Better, worse, or about the same? It looks better, like a lot of the charts here. This is a higher low in early September relative to this low. All of this has occurred for the most part above an upward sloping 250-day moving average in black. And during Fed week, as of Thursday's close, stocks were outperforming long-term treasury bonds by 2.62%. And if you know your stock market history, this ratio in September of the year 2000 rolls over hard. It moves in the opposite direction of this look here. And how about the numbers for this week? Again, month to date, XLP relative to SPY defensive ratio is down 0.98%. XLY consumer discretionary month to date crushing defensive XLP by 5%. This doesn't look like market participants that are concerned about a recession. This doesn't look like market participants that are concerned about a recession, telling us not to get too cute with our holdings and our asset allocation and to err on the side of trading less, if at all, until something changes. Again, if you go back and watch this video again, forget that the Fed just cut interest rates and just look at the charts in an objective manner. They tell us the market is open to outcomes similar to the outcomes on your screen following the first Fed rate cut. 2 years later, the S&P 500 on average was up approximately 15%. The NASDAQ composite was up on average 72%. Going into this week, it really didn't matter if the Fed didn't cut rates, cut by 25 basis points or cut by 50 basis points. In all three of those scenarios, we would simply trade the chart in front of us. And right now, the charts and data in front of us tell us the same thing that they've been telling us for several weeks and months, that the edge still goes to the bulls. It wouldn't be shocking if volatility continues. We still have an election coming up. Based on everything we know today, the bias over the next 6 to 12 months should be up. But it hasn't changed anything on this front. It's still important that we take it day by day and make no assumptions about any topic on any time frame. And as we all know, the only way that we can use all of this effectively is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.